This class will be concerned with stock control. We're going to look at the importance of stock and how it's managed. The emphasis here is mostly on secondary type industries. If you remember, we can classify industry according to three categories. We have the primary sector, which is related to fishing, agriculture, forestry. These are called the extractive industries, and we get them directly from nature. So that's the primary sector. The secondary sector is manufacturing. Manufacturing is transforming raw materials into usable output, which is then sold on to customers. And we also have the so-called tertiary sector, which is the third level. The tertiary sector is related to services, insurance, banking, marketing, and so on. Now, insofar as we're dealing with stock control, the main emphasis here will be on secondary. Could to some extent apply to primary as well, but it's very unlikely to apply to services. We don't hold stocks of services. They are consumed at the moment in which they are produced, generally speaking. So we're really dealing here with the secondary sector, and that's our main focus. Now, managing stocks of raw materials and semi-finished goods and components is important for any business in the secondary sector, in the manufacturing sector. It's of vital importance that stocks are kept at the right level, and we'll talk about what we mean by the right level in the later parts of this session. But it's important that stocks are kept at the right level, that not too many stocks are held because that's costly, and if too few stocks of raw materials are held, then production may be held up. So it's getting a balance. That's the important part. A considerable proportion of the company's capital may be tied up in stock. For this reason, it's important that it's managed efficiently. Now, of course, that depends on the nature of the stock. If we're talking about jewellery, then they may be holding stocks of gold or platinum, which are very expensive. If we're talking about other industries, stocks may not be so expensive. Well, the chances are they're not going to be that expensive. But the point is, a large part of the company's capital may be tied up in stocks. So it's important, in fact it's critical, that the business and the management control stock levels and do so efficiently. So stocks are usually important or essential to maintain production. Production needs stocks of raw materials, stocks of components, stocks of semi-finished goods. So production needs stocks, and the stocks needs to be efficiently managed. It's a vital part of running the business. Stock control involves planning to ensure that the business has sufficient stock of the right quality and that this stock is available at the right time. So it's important that businesses have the right quality of stock and it's available at the right time, ready for production. So let's talk a little more about the background to stocks and stock control. So as stock arrive in a store, we get used, and more used stock will be, some get used and more stock will be requisitioned. There is a cycle of reordering. So the stocks arrive in, the raw materials, let's say, arrive into the stores and they get used. Well, some of them get used. Some will be held in stock, held in the stores, but they will be requisitioned eventually and they will move from the stores out into production. So we can see it as a movement inwards, goods inwards. You can imagine lorries arriving with raw materials, putting the raw materials into the stores. There's paperwork, of course, to be completed. The stores will receive the goods and book the goods into the stock. But then the production manager will come along and book some of the goods, some of the raw materials out of the stores to make the product. So it's going into the store and it's coming out of the store. There will be a certain period of time in which it is in the store. And really that's what concerns us. How many or how much raw material is in the store, how long is it being kept there, and how is it dealt with. But there is a cycle of reordering that orders are going through all the time. Orders are going out into the shop floor, requesting materials to put into the machines to make the products. The stores are requesting deliveries from suppliers to replenish what's been used and to keep a stock. There is a problem in valuing the stock since prices vary over time. What's the value of the stock in the stores? I mean, orders placed with suppliers may be at one price today, but next week it may be a different price. So how much is the value of the stock in the stores, and how is it valued? Because there are different prices. As raw materials are delivered, some are delivered at one price, some are delivered at a different price, and so there's a complication about the valuation of the stock, how much stock is being held. And really, it's the value of the stock that's important as far as management, senior management, is concerned. It's how much cash is being tied up in stocks. So how is it valued? Now, it's very important because stock value is one of the components of profit. If the company is spending on stocks, it's like an outgoing. It's an outgoing that hasn't been used. Of course, when it goes into production, it becomes a valuable item. It's necessary in production to make the products that go on to be sold to the customers, that meet the customer's requirements. But it's important that the stock is valued appropriately. We'll come back to stock valuation in a moment, but stocks include raw materials and components from suppliers. So the stocks held in the stores will include raw materials. It could be sheets of metal, or it could be components, it could be semi-processed components, components that have been manipulated in other businesses and bought in from other suppliers. So we have stocks of raw materials and components from suppliers. There's also work in progress or part finished goods made within the business. Sometimes if orders are slack, if there's not much work to be done, customers haven't placed many orders recently, then to keep the machines running and to keep the business operating, management may get the workers to produce items into a semi-finished state. These are work in progress, and they may go back into the stores and be stored there until they're needed. So the next time an order comes in, the work in progress is brought out and completed. So the cycle has been shortened, and of course the customers will get the product even faster. So sometimes work in progress is a way of maintaining production, even though there are very few orders for the company to complete. But when the orders do come in, they may be met out of work in progress plus some more work, some additional processing, and then the product is completed and delivered. So the cycle has been shortened. There may also be stocks of finished goods held in the stores, waiting for dispatch to customers. Sometimes the business may have the capacity to produce surplus stock, which it may do, and hold those waiting for orders, in anticipation of orders that will come in from customers. So that's a possibility. The stores may also, or stocks may also hold consumables and materials used by service businesses. So the stores may hold printer ink, or it may hold paper for the offices, or it may hold different items, consumable items which are used up in running the business. It may hold parts of machinery that have been put into stock in anticipation of the machines breaking down, or it may hold items for the office. So there are all sorts of consumables that the business use up in the process of manufacturing. It doesn't just use raw materials. It uses paper, printer ink. It uses many items, and these are called consumables, and they may also constitute a stock. Now go back to the valuation of the stock, which I talked about earlier. Now we've got an idea of what the stock is, or can be composed of. Let's see how it's valued, or how approaches to the valuation of stock. The first way is called FIFO, F-I-F-O, FIFO, first in, first out. The stock used is valued on the basis of the oldest price of the stock. So stock is flowing into the stores all the time, and the oldest stock in the stores, the price of the oldest stock, determines the price of the stock. So it's the first in, first out. So that one, the next order that's drawn off by the manufacturing section, by the production section, will be priced at the oldest price in the stores, the oldest stock in the stores. It doesn't mean the actual physical oldest stock is used. It could be stock that just arrived, but it's priced at the oldest stock in the stores, because that's what was paid when it was first bought into the stores. The second way is called LIFO, last in, first out. Stock used is valued on the basis of the latest price in the stock. So now you have to imagine the stores having many items in stock. They're all bought over different time periods at different prices. When the production manager requisitions raw materials to go into production, the stores would now charge them the latest price, the last price, on the basis that that is the price that's in the market. So whatever's in the stores bought previously, perhaps at lower prices, they should be now valued at the last price, because that is the price that's been paid currently. There's also an average cost. It may value the stocks in production at the average cost of the items in the stores. Just take all of the items. It's a weighted average, so you take the amount of stock at one price, find out the cost of that, the amount of stock at a different price, find the cost of that, add it all together and divide out, and you get an average cost. It's a weighted average cost. So the beginning inventory, the beginning amount of stock in the stores, plus the purchases, the net purchases, minus the cost of the goods sold, will equal the ending inventory. So if we take a time period, at the start of the time period, look at this, the amount of stock, the value of the stock in the stores, plus the net purchases over the period, minus what's been put into production, and that will give the final value of the inventory. Let's look at it in terms of numbers, just to drive it home. Let's say we have a business, and I'll put the cursor onto the screen. Okay, we have a business here, and this business we've got, in January we receive 300 items into the stores, and the cost is £7, $7, $7 whatever. We get 300 of these things, whatever they are, on the 1st of January, and it's coming into the stores. On the 1st of April we get another 180, and this time the cost has gone up to £9. So it's £9 each, or it's $9 each, or whatever. And then in July we get a further 120 in, and now the price is £13 each, £13 each. Now, on the 1st of October, we start to use this. 350 is out. The production manager has requisitioned 350 of them. Now, the problem is, what's the cost of the 350? How do we value the 350 has been taken out? We've had all of these coming in and different quantities coming in, and they're coming in at different prices. So how do we work this one out? Well, the first rule we looked at was FIFO. So let's apply FIFO and see how FIFO would do it. FIFO is the first one in is the first one out. So we have 350, that's what the production manager wants. Well, in the 1st of January we got 300. So we take 300 at £7 each. A total of 2,100. So we've taken it's the first in, first out. So the first one in, 300, that's the first one out, and it's out at 7. Now we need 350, so we need 50. Well, the next one is 180. Well, we don't need 180, we only need 50. So take 50 out of the 180, so 50 at 9. Tot it up, multiply these out, and then tot them up, and we get, we get 2,550. So that's the cost of the 300 we have booked out. Sorry, the 350 that we've booked out. And that's how FIFO would value the amount that's booked out. Now, LIFO, the last one in, first one out, last one in. We have the same arrangement here. These have come in over this period, and on the 1st of October 350 have been requisitioned by the production manager. So now we go last one in, first one out. Well, the last one in was 1st of July, that's 120 at 13. So we go 120 at 13. So it takes all of those out, which will give us the amount booked out there is 1,560. That's the value of that particular aspect of the order. Now 120, well, the last one in, first one out, first out. We need 350. We've got 120 that's been taken out. So we still have 230 to go. So we need to go to the 180. Well, 180 at 9. There we go. 180 at 9 is that. So we're working from the last one, July, 1st of July, back through April. Now when we got 120 and 180, we've now done 300. 180 plus 120 is 300. But we need 350. That's what the production manager wants, 350. So we have to take 50 out of the January one. The January one costs 7. So now we come down 50 out of, at 7 I should say, which is that. So with LIFO, the last one in, first one out, is 3,530. So you can see the contrast between the two. Sorry, I've just go back. Okay, you can see the contrast between the two, which is 2,550 versus 3,530. It's for management to decide which one is used. So how the stocks are costed. The stocks that go into production are costed. Now, stocks are necessary to meet customer orders. Some companies may be able to use just-in-time approach. In this case, no stock is held. Just-in-time is an approach to production in which the deliveries of the raw materials is synchronized perfectly with production within the business. So the lorries arrive with the raw materials, and the machines are waiting to process them immediately. They don't go into stores. They just go straight onto the machines. They're processed, and at the end, they go straight to the customer. It's a very efficient view of the business. You could say there are issues and there may be problems with this because if a machine breaks down, for example, or if the lorry broke down on the way to make the delivery, there could be problems. So it's worth reading about just in time to see what the issues are and how writers consider how these issues can be overcome. Clearly, if stocks are not adequate to meet orders, the orders may be lost. So it's vital that the company has got the raw materials when required, whether it's coming out of stores or if it's a just-in-time, a JIT approach. But clearly, the company must have the raw materials to process, to make the products that the customers want. Otherwise, the customers may go elsewhere and the orders are lost, revenue to the business is lost, the business may get into trouble. If it doesn't have enough raw materials, it's called stockout. A stockout is serious because it means the machines are idle, the company's not producing, it's waiting on deliveries. And that's inefficient. Stock holding is a balancing act. That's what I said earlier. It's having the right amount, not having too much and not also being short. So it's necessary to hold sufficient stock to meet orders and anticipate orders and anticipated orders. So it's necessary to hold enough stock to meet the orders that are currently on the books and also what may come in. So it's necessary to talk to the marketing section to see what customers want, what they're likely to do, if they're likely to place orders, so that the company can prepare for likely orders in the future. It should minimize stock, I'm sorry, it's not strict. Minimize stock to reduce the opportunity cost of holding stock. Now, opportunity cost is a term often used in economics. An opportunity cost is defined as the cost of the next best alternative that's given up. So it's the cost of the next best alternative. Now, the next best alternative to holding stock may be having better cash flow, having the cash that has gone to buy the stock, having that cash in the bank, easing cash flow problems for the business. So putting cash into stock ties up the cash. So the opportunity of holding the stock is not having the cash, because the cash has now been turned into stock. So having the stock means not having the cash. That's the opportunity cost. So I give a definition here. Opportunity cost is the cost of the next best alternative foregone. It's the cash tied up in stock can be used for alternative activities within the business. It may be to ease cash flow, as I've said earlier, or it might be to buy a new machine, which is desirable and needed. So the cost of having the stock is not having the machine. The true cost of the stock is the machine that we don't have, if that is the next best alternative. So holding stock involves a cost, the cost of what we can't get because we've put the money into the stock. So stock holding, the cost of stock holding include opportunity cost of working capital tied up in stock that could have been used for another purpose. That's what we mean by opportunity cost, and that's real. It also involves the storage cost, the rent, the heating, the lighting, the security costs of a warehouse, or trying to get organization within the warehouse, trying to equip the warehouse so that it becomes an efficient store for the delivery of the raw materials and the semi processed goods. It's the bank interest. The stock may be financed with an overdraft or a loan. The business may have had to borrow the money to hold the stock, in which case there might be a bank interest. And also there's the risk of damage by fire, flood, theft. The stock may be damaged by any of these causes. There may be insurance that the company has to take out to try and secure the business. But again, it's an additional cost. And of course, stock itself may become obsolete if buyers' tastes change. If the buyers no longer want that product, they want some variation, then some of the raw materials, some of the semi-finished products, they may become obsolete. So there's a risk in holding stock as well. And of course, in some industries, the stock may be perishable. Holding food, for example. So in the catering business and in food processing, there are many issues about perishability and the problems of stock. Now let's talk about stock control, how we control the stocks. Well, examples might include a growing business will need to frequently review its reorder and buffer stock levels. Now, its reorder level, that's the critical point in which the orders are placed with the suppliers. And when a stock drops to the reorder level, the company places the orders. Buffer stocks are the reserves. These are what the company thinks it must hold just in case there's a problem with delivery or with suppliers, or suddenly there's a big increase in demand for its product. The buffer stock is its security. A business must be conscious of seasonality in the demand for the product. So holding stock, it must factor in seasonal demand. Certain times of the year there may be consumer sales in January or in the summer. So it's necessary that the business holds stock to meet those times, that seasonality. The ability of the supplier to meet orders should be constantly checked. Perhaps also review alternative sources of stock supplies. It's important that the business knows its suppliers, knows their capabilities, their reliability, their history, knows what issues are going on within that company. If the company is investing in the latest equipment and are committed to supplying good quality product at the time required, it's important that the business knows its suppliers. The essential factors that need to be borne in mind in the context of stock control may be seen in a stock control chart. Although a very simple chart, illustrates the main points. And the one that we'll look at is the so-called sawtooth shaped diagram. Sawtooth shaped diagram. That's the name of the diagram, which we'll look at in a couple of moments. So it's probably best if we move our discussion into a more pictorial presentation, just to see what's happening with stock. Now, first of all, let's look at the terms used in the sawtooth diagram. We have a minimum stock level. That's the first point. The minimum stock level, this could represent sufficient stock for a given time period and may depend on the capacity of the warehouse or on the reorder size needed to qualify for a quantity discount. This is known as the economic order quantity, the EOQ. Now, what we mean here is that a minimum stock level should be just sufficient to give time for deliveries to arrive. So the production manager is drawing off stock from the store. The stocks in the stores are reducing. This should hit some critical level, and at that point that triggers reorder. That's the minimum stock level. So there's the reorder point, and the minimum stock level, I should say, is the one that's below the reorder point, but that's the point below which stocks should not fall. But on the way down to the minimum stock level, there is the reorder point. And the reorder point, the quantity ordered there should be the economic order quantity. It should take into account discounts for certain quantities, discounts on the terms of the order, and so on. So there should be time to take benefit of any discounts that are available at that time. The reorder level, well, this acts as a trigger point, so that when stocks fall to this level, the next order should be placed. That's the reorder level. The time between the order and its delivery is known as the lead time. So when the order is placed with the supplier and the actual time the supplies are delivered, that time period is known as the lead time. The size and timing of the reorder should take the lead time into account. Lead times are important because once the order has been placed, how long will it be before the goods actually arrive? That's the lead time. The minimum stock level is also known as the buffer stock. This is a just-in-case stock. If there are delays in the delivery or there is some sort of exceptional demand, customers suddenly want extra quantities, the buffer stocks may be dipped into. These are reserve stocks. Please note here that what we're dealing with is a long way away from JIT, from the just-in-time approach. With just-in-time, everything is synchronized. There would be no buffer stocks. With JIT, there would be no stores. The items would arrive off the lorry, go straight into production, and go straight to the customer. There is nothing in between. It's a super efficient view of the business. The one we're talking about, there are buffer stocks. There may be problems with machines breaking down or problems with getting deliveries of raw materials or whatever. So buffer stocks are held just in case. So we're not talking about a JIT situation here. Let's look at it. So we have stock levels on the vertical axis and we have time on the horizontal axis. That's what I meant by the sawtooth. It's like a sawtooth, like a blade on a saw, that sort of shape. And if we look at it here, we start at just above 700. I'll just put the cursor on here for a second. We start here at just above 700 and then it declines. And we're making an assumption here, it declines smoothly. Just to make the diagram easy to understand. We're saying that the stocks decline continuously over a time period, just over a month in this case. And then, once we get down to here, the stocks jump up again and start to decline again. And here, jump up and start to decline. So what we've got then is this drawing off the stores with the stocks declining, and then a new delivery, stocks declining, a new delivery, and so on. So we have the maximum stock level. What is the maximum the company will keep? Well, in this case, we'll say it's 730. So that's the maximum the company will keep. The reorder level, well, in this case, we'll say it's 440. So we'll say here, at this point, once the stock is declining along here, it's falling all the way along here as time goes on. And once we get to here, the company places a reorder. It looks at discounts, it looks at the terms and conditions of the delivery and so on, and it places an order at this point. But now the order's gone to the other company, but stocks continue to fall in the stores. and then the order that was placed will be received and the stocks will jump back up to the maximum stock level, start to decline again, and at this point more is reordered and it starts to decline. So at the very bottom here is this buffer stock we talked about. The buffer stock is the just in case one, just in case something goes wrong. It's the insurance. And the lead time is the difference between when the order is placed, the reorder level, when the order is placed, and when it actually comes into the stocks, comes into the stores. So this is when the order is placed, this is when the order arrives and the stocks jump back up. So that's a way of looking at it pictorially, and that's quite a famous diagram, and it's worth understanding it and make notes about it. Now, stock taking. Well, a simple approach to stock taking, because it's important to find out what is in the stores. Well, a simple approach is simply to count what's on the shelves. It's stock taking. It usually involves barcode readers and electronic aids and so on, but essentially trying to find out what's in the stores. Many businesses undertake an annual stock take. This checks the discrepancies between what is actually in stock and what's shown on the records. It's often the case that stock records do not reflect accurately what's in the stores, because sometimes people book out items or take out items and they're not booked out, or sometimes people recording transactions misrecord them. They write down the wrong quantities. Sometimes people transport numbers. Instead of saying 61, they'll say 16. So whatever. The point is, there usually are mistakes of some sort. So it's important that stock taking takes place to make sure that what the records say are accurate. Many companies use this exercise to review its stock holding policies and also search for slow moving and obsolete items. Stock control can go so far in helping the business, but the information must be accurate. And stock taking means that items which are not moving can be identified. It may be possible to sell them on, to sell them to other companies, or move them out of stock because they're no longer needed. They're just taking up space, and perhaps they can be turned into cash, perhaps. Stock rotation. Businesses try to rotate their stocks frequently. This avoids the risk of stock deterioration and obsolescence. It's important to try and keep older stock coming through, so it's not deteriorating. It depends on the nature of the stock, of course, but it's not deteriorating. It's not sort of wearing out in the stores. By the time it gets into production, it's valueless. It's no use. So it's important to keep stock rotating. It's very important in some areas more than others. Perhaps in the food industry, when food has been stored for a certain period of time, it's necessary to bring it out and get it used. It can't be kept indefinitely in the stores. As stock arrives, and again, as it is sold, scanning of barcodes keeps stock levels up to date. Well, the use of electronics in stores management has tended to reduce errors. The only possibility is that the same code is scanned twice by accident, or errors such as that occur. But moving towards electronic entry has tended to reduce the number of errors in discrepancies between stock records and actual stock in the stores. The just-in-time stock control we talked about earlier. Well, this approach makes stock orders only to meet specific orders. So in this one, the customers place the orders, and then the business place the order for the raw materials to complete that order. So there's no stock being held. It takes a lot of confidence to do this, and it depends on the nature of the product. It depends on whether the customers can wait. It depends on whether the suppliers have got the raw materials in stock and can deliver quickly to the business. So it requires a lot of confidence and a lot of organization, but if that's the case, then orders are only placed to meet specific orders. So the business carries little or no stocks. Well, theoretically, no stock. The stocks arrive and they go straight onto the machines, they're processed, and they go straight to the customer. So it requires a very responsive and reliable source of supply. It's important that the suppliers are capable of meeting the requirements quickly and efficiently. Now the overview. Well, the overview, the types of stock is important to look at. Raw materials necessary for production to take place. Well, raw materials are necessary for production to take place, and that's the first type of stock. Then we've got stock which is semi-finished stock and components. That's a second type of stock. So the business has got different types here. We've got raw materials, that's one type of stock, work in progress. Then we've got finished goods. They may be held ready for dispatched. So we've got three types of stock. The warehouse or the stores will have to manage these in an efficient way to make sure that they're not holding each other up. They're not inhibiting the efficiency of the warehouse. So they'll have to be compartmentalized. But of course, we've also got the consumables that the business needs itself. I mentioned earlier office supplies of all sorts, from pens, papers, parts of office equipment, and so on. That's stock that must be managed. There's also production equipment such as plant and machinery and their spare parts. Spare parts have to be held in stock. And there might be parts of the machines that are held in stock. And there are problems with overstocking. As I said earlier, it's the risk of stock becoming obsolete. The stores are holding stock, but suddenly, or for whatever reason, the market changes and the stocks are no longer required. So the stock is obsolete. And then the company has the problem of trying to liquidate the stocks, turn the stocks back into cash. And it may lose on that transaction or series of transactions. There could be a high storage cost. Depends on the volume of the stock and the weight, the complexity of the stock. It might be that the stocks are difficult to store for all sorts of reasons. And as I said, capital is tied up in stock. So it's costly to hold the stock. And there are problems due to stock out. This is when the company runs out of stock and production is held up. There's simply no items to produce because there's no stock to produce them. Customers' demand could not be met, leading to business losses. The customers may get fed up waiting and move their business elsewhere. So stock out, when customers' orders are held up and customers become frustrated because the production lines are held up because there's no stock, there's a stock out, then that's serious for the business, because the business's reputation may be damaged and the customers may in future go elsewhere for their supplies. And frequent ordering and handling stock may lead to higher costs for the business. There's an admin cost trying to progress through different orders and handle the different orders. So it's higher costs for the business. So in this video, a bit long, we've looked at stock control and various issues associated with stock control. It's a very important video. It's well worthwhile going back over it, freezing it, making notes, running it over a couple of times. It's a very important video with many important concepts built in. But that's all I'm going to deal with at the moment, so I'm going to leave it at that and say thank you for watching.